Investors are worried about the fallout from a deepening slide in Chinese currency. Foreign exchange markets are rapidly pricing in further trouble for the Chinese currency and Chinese stocks as President Trump steps up to his trade rhetoric. Already, $50 billion in tariffs against Chinese imports are coming in, and another $200 billion in tariffs are on the way. Beijing has yet to respond fully, but it could be allowing its currency to decline to offset the higher tariffs as the yuan recently fell to a roughly 12-month low against the dollar. The situation looks like it's going to get worse before it gets better. And so today, we're going to talk about 4 Chinese stocks that are at risk. So let's take a look. First up is Alibaba Group, and the symbol is BABA. And Alibaba shares are threatening to fall back below their 200-day moving average and the 50-week moving averages, which would result in the first major downtrend for the stock since the doubling off of the prices in late 2016. The Chinese e-commerce giant is exposed not only to emerging weakness in China, but also to any plans to expand more aggressively in the United States market. The company will next report results on August 2nd before the bell. Analysts are looking for earnings of $1.33 per share on revenues of $12.4 billion. And when the company last reported on May 4th, earnings of 91 cents per share beat estimates by 3 cents. However, if you go back and look a little bit further in the history of the stock has traded with much more volatility recently. So be careful. And Alibaba is essentially the Amazon of China. So if this trade war heats up, there could be more problems for Alibaba Group. Next up is Baidu Inc., and the symbol is BIDU. And Baidu Inc. shares are threatening to fall below their 50-day moving average, remaining within a trading range going back to the fall of 2017. The company has made efforts to push into new technology ventures such as autonomous driving, but U.S.-China trade relations could sour any crossover with Silicon Valley firms and hinder any progress. The company will report next results on July 26th after the close, and analysts are looking for earnings of $2.56 per share on revenues of about $3.9 billion. When the company last reported on April 26th, earnings of $2.60 per share beat estimates by 89 cents on a 36% rise in revenues. And I followed Baidu for some time, but given its long-term chart, in my opinion, this is not the time to buy Baidu. And number 3 on the list is Weibo Corp, and the symbol is WB. And Weibo Corp is known as the Chinese Twitter, but the stock is threatening to fall below the late June lows, capping a decline of nearly 40% from the highs last seen in March. Recent results have fallen short of analyst estimates, and the team at BNP Paribas recently initiated coverage with a hold rating. Not all that encouraging. The company will next report results on August 8th before the bell. Analysts are looking for earnings of 66 cents per share on revenues of $428.9 million. When the company last reported on May 9th, earnings of 50 cents per share beat estimates by 3 cents on a 61% rise in revenues, which is good. However, my long-term charts show that WB has further to fall, so be cautious. And last stock on the list is China Mobile, and the symbol is CHL. And China Mobile shares have been hit by reports that the Trump administration has cited national security concerns to deny China Mobile entry into the United States, keeping China's largest state-owned telecom away from American consumers. And this blocks an application that has been pending since 2011. The stock has been sliding for years since topping in early 2015 and is down 25% from the highs last seen in late 2016. However, China Mobile has a decent long-term chart. So let's take a look. And this is the long-term chart on China Mobile. And again, the symbol is CHL. And as we can see here, that it did have a high in early 2015 at that level, which was probably in the upper 70s. It's declined ever since then to the current price of about $44.67 at this point here. Now, given the peak way back here in 2007, and then the bottom at this point here in late 2008, it really pretty much traded sideways for the most part, except for the 2015 high. So it's not really all that volatile, and you might not be able to get much appreciation out of it. But China Mobile does have a decent dividend of about 4.6%. Moving here into the MACD, you can see that we're at levels that we have seen only back here in the 2009-2010 timeframe, and then here from 2002 into 2003. The histogram doesn't look as bad. The histogram is much better than those previous periods back here and back here. So that's somewhat encouraging. The relative strength as well is down at multi-year lows. And so perhaps it's a lot weaker, but at the same time, that might provide for an opportunity here coming up. Again, you're going to have to look into this stock, the fundamentals, as well as further technical analysis. And here in the stochastics, we are trundling along the bottom here. Now, we did that from 2001 all the way to 2003, so that can extend for some time. So you're really going to have to look into those fundamentals to make sure that revenues and earnings are on track. And volume looks fine, nothing wrong with that. And then the Williams as well, showing that it's trundling down here, the bottom in the oversold territory for quite some time. It can stay there, as you've seen here back in 2001 to 2003. So nothing's going to say that it's ready to roll. However, that's why you need to conduct further technical and fundamental analysis. Of all these four, though, China Mobile might show the only opportunity of those stocks that we've covered here today. So for ChewDog Charts, thank you.